All right, welcome back everyone to this week's live stream. So we got a lot to get into. Funnily enough, not much has actually changed since the last live stream where we talked about, this being one of the more hated rallies, things going on in energy, why the energy hyperboles were, misled. And you guys can see some of the topics we're going to be talking about in today's title, some of the imagery used in the thumbnail, and in the description below, you'll see the timestamps that will be sort of a guide for how we're going to go through today. So, first 5 minutes, we're a few seconds from hitting that 5-minute mark, and we'll get started. We are going to first talk or discuss energy and what's going on there. And then we're going to move on to the other topics that you see listed below. As always, if you ask questions about the topic at hand, we'll get to those first. I'll prioritize them. And then if there's a topic about a previous topic that we've talked about, I'll go through those. But don't worry, I'll get your questions at some point towards the end of the stream. But yeah, so markets in general right now, right, 4 seconds. I'll go ahead and start. So energy markets or energy investors, let's call it the hyperbole. So let's define first the hyperbole so we don't have any confusion. I'm mainly talking about the folks that kept piling into energy and talking about energy in a sense that there's going to be, $200 a barrel in oil. We spent a good part about the last live stream going over why there's a lot of mechanisms that prevent that. One of them being just like the natural trickle of demand destruction across various markets before something like the US or Americans start to actually feel that demand destruction. And then so what we're seeing now, there's a lot of perplexing behavior, a lot of these hyperboles. You might be, and I'll discuss a little bit where I land on oil. But a lot of these hyperboles, they're you can probably see them on social media, on X, on YouTube, etc. In their various podcasts. They're expressing a lot of frustration because the trade worked out in the beginning and then sort of trickled off into nothingness. And they were expecting, oil to be, going up even more. And they're upset or frustrated with the trade. They care more about being right than necessarily making money. They're getting very emotionally invested in some cases. I won't name specific podcasts. I'll be respectful. But if you guys know, we've talked about it plenty in Capital Mindset, kind of sharing their podcast, kind of having a little bit of a laugh at them a little bit, I should say, watching them really get frustrated at things. But nonetheless, energy as a whole has done fairly well, despite that whatever this pullback is, because not really a pullback. I just think they were expecting and they were positioning for a much more violent move, and it's pulled back a little bit this week, 7%, but it's really flat over the past month. And if you look at the 6-month performance, it's still really respectable. So energy's done really well. And let's talk about where we were last year and where we are today. So last year, energy was in a bad spot. There was a lot of people predicting that energy was, going to go even lower. And so that was a good time to take a bet on energy. Some Capital Mindset members, we were involved in Valaris, ticker symbol VAL. No position right now. And there's a few other oil companies that some of the commodity guys really liked, and they did really well this year. But that being said, right, there's a at least I can speak for the members. Even among them, there was still this general understanding that a lot of these themes were strikes, that oil as a commodity has its limitations on certain bands within a certain period of time of how rapid it can expand. Given the relationship it has with overall demand, what demand destruction can do to the quantity demanded, and what that then has an effect on price and ergo profitability. But nonetheless, a lot of these companies are still in a really good position. Where I think oil is going to end up being is higher than we were before, but nothing crazy or anywhere close to $200 a barrel. I'm thinking oil is going to be $80, $90 a barrel, maybe high 70s, and I think that's a very fair spot for it to be. And if you're sort of planning and investing in according to that, longer term or medium to long term price point, and the stock makes sense, then you could build a position. There's actually quite a few oil companies out there that do actually make sense at those price points. Now, if your investment requires energy to go bananas, then perhaps maybe I don't know, maybe you do you, but that's where a lot of the frustration some of these hyperboles are coming from, because the way they invested might be in a business that requires a certain amount price for them to eke out, or maybe they used a lot of leverage, maybe they used a lot of contracts to get the exposure, etc. And if you're long oil, the commodity itself, well, that's a whole different ball game together. But I would be more interested personally in going long an equity. We talked a while ago about Petrotal, which was one we liked. I know that Carl Jr., whenever he watches this, we talked about that. He liked it a lot. He invested in it. We're not giving financial advice, so just talk about stocks you guys asked me about. And if you guys ask me, like, what are some interesting energy names, that's one I provided. And there's a few other Canadian ones that are interesting. Even at this prices, they've pulled back a little bit. My favorite oil company is actually Canadian. Has probably the largest reserves I've ever seen in an oil firm. But then there's also Repsol in Spain that's done fairly well, going through their transition, but they're going to be a buyback machine, etc. But point is, right now it's starting to see some capitulation from these hyperboles, and that I think could make it interesting to add or to build a position in energy at some point in the near term. But it's kind of still wait and see on how much downward momentum energy names could have, because perhaps a lot of that has to deflate because those expectations might be going away. That being said, I don't think energy is going back to the price pre-war. So a lot of people think that was a normal price for energy to be. We talked about that last live stream, the live stream before that, as we've been updating the Iran conflict. Energy was not in that Goldilocks zone, that sweet spot where it still encourages exploration and is still okay for the economy, doesn't cause demand destruction, because you don't want energy too high, you don't want energy too low. Energy, when it's too low, can cause future supply shocks simply by disincentivizing further exploration. And so we want energy, in theory, to be in this Goldilocks zone, which I think is actually where it's returning to. So when energy gets to, if it stays around the high 70s to around the 90s, I think that's a sweet spot for where enough exploration is encouraged. We don't have that high of an energy price where you have demand destruction to the point where you're wrecking the economy, et cetera. Because, for example, if you saw $200 a barrel per oil, yes, there's probably going to be demand destruction, because even adjusted for inflation, while $100 a barrel per oil isn't what it used to be, again, if we adjust for inflation, $200 a barrel for oil is roughly where that tough part where we saw in the early 2000s what oil got to. So there's also the discussion of, okay, so if energy starts to get interesting, to at least put it on your watch list, find the companies you think are good. What are the things we're looking for? So some of the things you might be looking for is companies with low break evens, really good reserves. You could look at the known reserves and the probable reserves, but known reserves, solid, and capital distribution, is it favorable? So if a company has maybe some short dated reserves, they don't really have the longest reserve life, you might want, and hopefully, I think most of them that I know of do this. They act as cash cows. They're not buying back tons of stock. Instead, they're distributing it via dividend. And eventually the company at that point in time, if you'll know if you look at the company, like Petrotal is an example where they're not really going to go out and buy new assets. They're going to cash cow it until they're dead, and then there's nothing left. And so you're just going to get a lot of your capital return via a dividend. And then others that have a very large theoretical present value, massive reserves, low break evens, you probably want to look in to see if they're doing some sort of buyback policy. And the ones that we know about are doing that. And then you have, of course, like some of the majors, different qualities within the majors, but can't really go wrong with some of the blue chips. Again, this is if you really wanted and you're itching for energy exposure. But this is not to say that energy stocks as a whole might not go lower. And then there's, of course, the royalty firms that add a little bit of a interesting layer of complexity. Some of them might get to a point where they're pretty cheap. Energy has this tendency of fluctuating between loved and hated. Loved for a little bit, hated for a long time. Some might observe, and it's all I'm trying to say with that is like, don't be surprised if a lot of the deflation and appetite for energy starts to show up again. We might see further pullback. But if you're looking for energy in your exposure and you wanted an opportunity to add or build to a position, I think you're getting it, or you're going to get it in the not too distant future, as in right now. But circling back, kind of pat on the back, the hyper bulls on energy, at least so far, and for so far that mattered, they were very wrong. And they were very wrong for the reasons I won't repeat that we talked about in the last live streams. Okay, so let's see here. Great questions on memory, so I'll start that. We will be talking about memory later. Oh yes, yeah, I'll say yes to that. That's easy for me to answer that. Yes, it's still intact. I'm long American LNG for energy, very long time horizon. VG is my best. So I have a few that I can share, but VG's good, right? VG's there's a few others that could have a bit more torque, but VG's good. So VG has some projects that in theory are going to be actually quite lucrative. And by the time those projects come online, there's going to be a much more of a catch up in American LNG to international LNG. So VG is a good one, right? The one thing we didn't like about VG before, but resolved itself a lot, was the lawsuits. So it appears as though that headwind is behind them. There's a few of the blue chip energy plays in gas. One of them, my favorite, is EXC. And I think that one's, you buy that one, you throw it under your pillow, and you look back in 5 years from now, not financial advice, but you look back in 5 years from now, I'd be shocked if you didn't make money if the thesis plays out on net gas spot rates in the US, at least catching up a little bit to what's going to happen or what we see internationally. But we got to build the infrastructure to get it out there, because net gas is very complex. VG is building incredible facilities. LNG, Shireen Energy, they have incredible facilities. These are very expensive, complex to build. So you can't go wrong. I'm psychologically long VG, no position right now, but yeah, I'm cheering you on. I think that's a good idea. If you can stomach, the fluctuations that you may or may not see, because I haven't kept track. I don't even know what price it's at right now. Okay, so it's down 4% today, but does it deserve to be down 4% today? Probably not. But it's just getting a sell-off with broad energy. You got to have a longer term vision, which I already can tell by your comment that you do. So yeah, you hold that. I think you'll be fine. We'll talk about Dave getting included, and then does Becky have more money again? Yeah. Consumer's dead, man. I don't know what to tell you. Consumer is really dead. All right, so making sure we're good on time. All right, we won't talk about semis until the 30-minute mark, but yeah, the name of the company, I said the ticker, but here, Expand Energy. So these guys have actually done really well since their IPO, as you can see here. They have a great balance sheet. I think this gives you a lot, or a satisfactory exposure to that same theme. And I think we'll have one of the higher torques when that catch up happens. And like I said, their reserve, well, I didn't say this part yet, but the reserves that they have, ample, very healthy, very visible, easy to sort of map that out, discount future cash flows to today. You start playing around with those estimates of what spot rates are going to look like, and there you go. I'll talk a little bit about it, because we have time before we talk about semis, about one of the things that we're pretty long, and it's the theme of U.S. reindustrialization, U.S. Economic activity picking up. So I'll name some tickers. The ones I'll name, disclosure ahead of time, we are long all of these names. We didn't get long at today's prices. These are holds in some cases for a while. And I'll say one of them that we added not too long ago. But I wanted to address that first and foremost, and I'll walk you through which ones we've held for a while, which ones are pretty recent. But one of the ways we've been playing this reindustrialization theme and just U.S. economy picking up is trucking. And so I've talked about trucking in previous live streams as well. But ODFL, there's a lot of things to like about that. We had a basket of trucking that we actually ended up consolidating all into ODFL. So now ODFL is our only trucking play. This is we've been long this theme going back last year when we saw the turn happening. A lot of trucking was in what you can observe by the stock prices in quite a bit of recession. So I'll use ODFL. Did I say ODFL we consolidated to? I'm so sorry. I'm thinking ODFL because I wanted to put it up here in front. JB Hunt. And you see Andrew caught me. JB Hunt, not ODFL. Apologize. So for the record, we consolidated into JB Hunt, not ODFL. We used to own ODFL. We made good money on ODFL, but we consolidated it into JB Hunt. I apologize because my brain was thinking, I'm going to put ODFL on the screen. So ODFL, LTL leader, still think is going to do really well, but JB Hunt had everything we wanted. We had, again, this basket, and we thought, hey, if we're going to own this theme, at this point in time, we're the most confident on this one name. Let's consolidate. Amazon got into this as well. Where we think that might hurt is LTL, but there's enough demand, volume, and rate pickup that ODFL is also going to do really well. But JB Hunt has everything we were thinking about. It has the brokerage business. It has rail. It has all the other trucking, LTL, everything, all in one. And the folks that we've talked to in the industry, they said the gold standard, JB Hunt. So that's one way that we were exposed to this theme of reindustrialization, of U.S. economy picking up. You get that with ODFL or JB Hunt. And I'll put up JB Hunt just so you guys see that. So JB Hunt Transportation. Again, disclosure, we're no longer long ODFL. I fucked up with that. So sorry for the confusion. But we are long JB Hunt. We used to be long ODFL. We took profits and we consolidated into JB Hunt. Okay, so another one that we honorary shout out is a coal company. We went long Warrior Met Coal. The reason why we went long Warrior Met Coal, the thought process was quite simple. It suddenly worked out very rapidly because I guess the market's starting to pick up on this. But Warrior Met Coal just finished the massive capex on their newest mine, and that mine now, in terms of break-even costs, are going to be quite low. There's not a lot of upfront capex needed now. It's sort of maintenance capex, and the big capex will happen in about 26 years from now when they have to replace it, because the actual mine itself is going to outlast a lot of the equipment, machines, etc. Okay, so why Warrior Met Coal? Well, with that same reindustrialization idea or concept, what the U.S. is going to be using a lot of is metal. We're going to be needing a lot of metal to put it into, factories, into data centers, etc. Steel. We need a lot of steel. We need a lot of iron. And if you've listened to a few of the guys who cover, military defense contractors, if you listen to some guys who've covered, not even from the stock perspective, but just talking about, geopol, military strategy, some of the folks that actually more or less know what they're talking about, they either work in some capacity in the industry, one or the other. I won't name some podcasts here, but if you know, you know. So you might have heard that around that the United States needs to build more capacity or more capability to build munitions and the like. And so this is one aspect. So we're seeing a lot of reindustrialization in the military defense aspect. Warrior Met Coal benefits from that. We're also seeing a lot of reindustrialization in other parts of the economy, and of course, data centers. So all that together pushes met coal prices upwards in theory. And met coal prices have actually already moved ahead of this. So you saw most of the return recently. And I'll pull up the 1 year. If you go back 1 year ago, it went up quickly, very rapidly. It doubled and then sort of consolidated here, and then seems to be on the move once again. And so we got kind of lucky with our entry this time. Quite literally, It's right around this range, and I would still be a tacit buyer. I was talking to Blake, who's a member in Capital Mindset, and he actually pitched it in Capital Mindset. So shout out to him right around this period. And last I spoke to him, which was yesterday, he's actually continuing at. But long story short, the way you think about what Warren Met Coal is giving you somewhat exposure to is that, sort of base commodity reindustrialization play. And if energy in some capacity, if energy goes down in price or normalizes in price, that's also a tailwind for these guys, because energy input costs are one of the things that they have to worry about. And then another names, or many more names, is aluminum. So we have aluminum like Alcoa, and a few others. These have done really well, and sort of that same kind of idea and theme. It's about reindustrialization. Aluminum is sort of adjacent to copper. We're seeing massive demand flow from copper, and aluminum acts and can do some of the things that copper can do, but also does a bunch of other things. And also for aluminum, same thing as many of these other miners or producers, the base metals. They you might see a bit of a tailwind if energy prices start to normalize, and sort of we don't have that headspace of thinking, oh, is energy going to go to like 160 a barrel? And when you listen to a lot of the management teams from the various aluminum companies, and by the way, Stanley Druckenmiller did go long Alcoa, so he is also seeing this. You get the same concern consistently, which is all about energy input costs. And when they're thinking about, okay, do I open up a new facility in this place versus that place? What are one of the main concerns that they might have? Energy. So what are the costs of energy? And the US, luckily, has a very low cost of energy when it comes to natural gas. And so this energy cost is actually quite low. But yes, all that to be said, there's many aspects to play the reindustrialization theme, and all of them have done very well, and some of them will continue to do very well. In my belief, that most of the names I just put in front of you will continue to do well. They've done well. They'll continue to do well. Warren Met Coal was one we, again, went long recently. Trucking, we've been long. And aluminum is something that we've looked at extensively. Some of them look really interesting. Others, maybe not as interesting. But some of them, there's probably only one of the ones in my head. I won't say the name as a shitco, but Alcoa, I'll stick behind it saying, great management, great assets, etc. And there's a smaller ones that I won't mention on stream. So have we discussed Misty? Oh yeah. Oh, I haven't checked on Uber with the pullback. Great question. Let me star this one. We'll check on it in a second. Thoughts on next year in Dominion? Oh, great question on that. Yeah, I don't know if you were in the prior live stream. We talked about Klarna, and so Klarna's done really well. I said Klarna was way too cheap at the price point it was. $5 billion for the current GMV leader, probably the second best in terms of underwriting, but $5 billion was nothing. It's insane. Wait, thoughts on NextEra buying Dominion? So that is about energy. So I'll ask. I actually don't know if it will go through, and I haven't researched it enough to give you a thoughtful answer, to be honest, but it is interesting. It would consolidate a lot of different assets that I think NextEra's management is much better at, managing the portfolio overall. And I believe they have actually a lower cost of capital, which is important for utilities. I could be wrong on that, but yeah. Okay. Does that help Dow and LYB? The energy going down? Yes, it does. Dow and LYB, though, okay, so both of those firms, a little bit different, but they've been in another sort of, other mini recession for their industry. So they went through trough earnings, and they're likely picking up. And the Iran conflict also boosted or jolted those even more. So there's actually potentially a lot to look at. But what I'd be scared of is any sort of normalization or a continuation of the problem we had before, which is oversupply in their markets. I'm not educated enough to give you, and we haven't looked into it, frankly, enough for me to give you an idea on that. Off the top of my head, that's like what I'd be concerned about and what I'd be spending a lot of my research time on. What's the deal with MQ going forward? Solid long. We still think it's cheap, but we're not long MQ. but we still think it's cheap. It's on our watch list. I think it's like $3.70, which is kind of crazy, but yeah, no, there's other fintechs that have offered better value and give you more torque, but that MQ is more of a supporter role to them. So like an example, Klarna, the Klarna card, Marqeta supports that. They're the back end of that. But Klarna is the one that gets the main unit economics for it. And there is the problem with like Marqeta having to negotiate, and some of these clients have a lot of negotiating leverage over Marqeta. And when it's you see we're invading Cuba, is that actually happening like right now and you're just breaking this to me? Funny question. Thoughts on Kyle Kuzma? Kuzma? Kyle Kuzma? Who is that? I gotta look this guy up. Oh, the basketball guy. Okay, yeah, people already talked about that. Okay, yeah. 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 Uh-oh. You know, people who don't really get involved. Cole messaged me something. Okay, so it appears that we're attacking Cuba. All right, so that one's next. Yes, drone investments, also good. Basket of drone investments that we're long will probably do very well. Yeah, I pitched those already in Capital Mindset. I think we just got information today that the Pentagon or the U.S. government's actually going to prop them up because we need to build a lot of infrastructure to support military supply chains, and that comes with not just like what we just discussed, like Warren met coal, like building a lot of steel, iron, et cetera, to support munitions. And again, part of that U.S. reindustrialization. People don't know this, but a lot of the military defense contractors, the primes, they've actually started to focus inward and develop and start to spend a lot of CapEx to boost productive capacity for a lot of things that the United States maybe didn't buy before, but is saying we want the ability to buy these. So if you want to continue to get all these lucrative contracts, we would want you to build out this productive capacity. And that's having inroads in the US when we're looking at the investment runway on various forms of CapEx, not just data centers, because a lot of people think it's just data centers. That's not true at all. Okay, great question. So is the future? Is the future? Now we discussed NASDAQ changing rules so we can all buy a joke company. That's SpaceX. No, we haven't discussed it, but yeah. Yeah, we'll talk about that. I'll talk about Intuit later. Let me check how we are on time. So I should be talking about semis already. All right, so we're a little late. We're 1 minute late. So what's going on in semis, right? It was funny because I looked at the title for the last live stream, and I'm like, wow, nothing. I was telling the Capital Mindset members in the voice chat right before coming on here, was like, I'm looking at the live stream from last time we went live, and nothing has changed. And it was 2 weeks ago. And so, looking at Micron, looking at SK Hynix, disclosure, we're long SK, SanDisk, whoever, you get this idea. You go on X, it's like there's a war going on between the people who hate this because either they missed it or something, and they're espousing some things that maybe they don't understand, etc. But one thing that happened recently that we didn't talk about last time, because this is fresh news, but we had a suspicion. And I'll hats off to Andrew, my partner. He's been on this point the whole time, and so when it happened, he kind of was just like, oh. So it was these LTA agreements. So the LTA agreements are a new development that didn't happen last time. So people remember. In fact, actually, I don't think we can really see it, but the last cycle back here in like 2018, that was more the smartphone boom and bust. But what we didn't see out of that is this structural demand flow of this like lack of compute that we just didn't have, this compute capacity. And we didn't see these LTAs being signed, because that's a big problem. Like the question you should have had earlier this year. When I say earlier this year, actually, frankly, a month ago, when you're looking at the valuations, is like, okay, well, if the prices collapse utterly next year or the year after, Sure, yeah, probably, undervalued, or sorry, overvalued. But if this lasts 3 years, no, they're potentially undervalued at the price they were just even a month ago, because they were going to earn roughly their entire market cap and then some in profit. Um, and what these LTAs now do is give us a lot more visibility as to like what it is that they're going to be able to generate. Now, that doesn't mean the market, like this year we were talking about, puts the price at something that's absolutely crackhead. And yes, we need to potentially think about monetizing it, the positions. But that also means, there was still a lot of doubt, capital that was doubting this on the sidelines, that this doubt is being slowly eroded or removed. Now, that doesn't mean there's not going to be any volatility in the future. Like, it's not going to, shoot up directly to whatever price some people might think it goes to, and it could have a little pullback. Etc. Like these violent moves are extraordinarily violent in terms of the upswing. And so when we saw, memory die for a good, total of 2 days last week, there's a lot of people grave dancing on something that if they really put their money where their mouth was, they would have shorted it and then got ass blasted. But this sort of change in the fundamentals that genuinely did happen with these LTAs, I think a lot of people aren't giving it credit for exactly what happened. And memory in this era of AI, you sort of have to also adopt the theory or the thesis that the AI investment is a complete, whatever. Like, this is all just vaporware. We don't need all this compute. Models are going to stagnate and they're useless. All these things. So if all these things are true, and the investment cycle stopped, yeah, there's a huge argument to be had that memory is going to have its reckoning, a very violent reckoning. But if that's not the case, then you have to ask different kinds of questions, because you could still have not a reckoning, but a correction. And if you look at actually the drawdown from the prior peaks to the troughs, it's not even as violent as some people make it out to be. But the other argument that I think is sort of like, we looked at it and it's like, okay, well, duh, that's not really the bull argument, right? Was, okay, they're at peak margins. It's like, well, duh, they're at peak margin. Like, if margins on memory expand any further from here, there could get to a point where the price point is so expensive that you actually destroy the AI capex theme entirely, because you can't afford the memory. So there is like a theoretical top of what prices can get to, and we're probably closer to that than we are the bottom, obviously. But that's not the bull case, or necessarily supports a bear case. Because even if margins come down a little bit, but the volume expands, because remember, profit comes from two things. It comes from the price we sell something and how many of those that we sell. So if the volume expands, price comes down a little bit, you can still end up with more profit. And when we're looking at, again, where they were just even a month ago, that they were at a price point still, and even though we were up well over 100%, you could get roughly the market cap back in profit over the next few years. So the LTAs, why did Micron move up so violently, is because it genuinely changed the picture that a lot of capital on the sideline was a little bit concerned about. It's like, what is the price going to be next year, the year after, the year after? But these LTAs start to change that narrative and provide clarity. Hence, you have this violent move upwards. And I don't think, well, depends, because Andrew had a great post. It got a lot of visibility on X. So if you guys go check it out on X and you go to his account, you can see it. But he broke it down nicely to a gentleman who was asking, because I think it was a Micron bull, and the Micron bull was like, oh, I don't know why it's moving up this violently. And Andrew politely answered like what the market changed or saw in the news that made it do it. So anyways, all that to be said, it's been a hated rally. It's been very controversial. You either feel really strongly one way, really strongly another. And granted, conventional wisdom has always said these are, disgusting, dirty commodities. But I think it lacks nuance on like, okay, what occurred in the previous cycles? How violent was the sell-off after that? What happened fundamentally to the business, and what's happening right now? Applying that, it's not that this time is different. It's more that the comparisons being had before to each other, even the ones before then, were also not really comparable. This is actually this is the similar or the same as a previous cycle, the one that we saw pre .com. So pre .com, roughly 1995, all the way through .com, it was a similar setup. We were in this structural deficit for memory. And if you hated the memory rally back then, you hated it for a while because you just saw, like, prices go bananas, but you never really got back to the original price. And so that's probably like depending on where you bought, if you bought low enough, you're probably never going to see that price again for some of these. If you buy now, who knows, right? Maybe not, because I actually don't know what's going to happen. And there's like a discussion we had about margin of safety and the limitations of that. So for me, myself, like what I know now, we're exiting that range of margin of safety, or that realm of margin of safety. And I'd have to revisit it a lot more and figure out, like, where is compute going? Like, how much is demand? Because if without that, I can't make a definitive statement. It's like, oh, if I buy Micron today, it's it's going to double, triple, whatever from here, and you're never going to see this pricing. I can't say that. I won't die on that hill. But from where we were a while ago, yes, yeah, you're probably not going to see that price for quite some time. Are you going to see, like, for example, $200 per share on Micron anytime soon? I don't think so. I think the profitability and scale now supports definitely something above that. So that's something we'll revisit and we'll keep an eye on, because the thing is, this is such a dynamic story, and we don't know what the price could be, because there will be probably a price in the future where we say, okay, well, we are taking our profits, we're moving out. But it's something we're monitoring daily. So when I also disclose the position we have in SK Hynix, I should also disclose that we could be out tomorrow and you won't know, because we're not talking on a daily basis, right? But we could be out tomorrow. We could be out next week. We could be out a year from now. We don't even know that when we're going to take profits. I don't want to add that disclosure. Okay, so I just wanted to get that in the tidbit there. And you look at NVIDIA is sort of weak, but we talk about this a lot, how NVIDIA itself is so liquid. It's actually the most utilized funding short for many funds portfolios. So it's a great funding short because it's not going to have this like super violent inflection upwards like some of these other names are having. And for a quick recap, so funding short is typically like, if you're depending on what your prime broker is like, you can short a stock and then go long using that same proceeds another stock that you think is going to have more upside, and you capture the profit, the difference between the performance of the two stocks. So it's essentially saying, like, NVIDIA will underperform this random AI CapEx stock that I found, and NVIDIA, by many, many, many different funds out there, is being used as a funding short. And so it's not something saying like NVIDIA is a crap company or it's not going to be higher, because it could still go higher and the funds still do fine, because what they invested into long wise went up more than NVIDIA. So hopefully that makes sense, because it's not that they're betting that NVIDIA is going to go down. NVIDIA can go up and they still will do well. And the benefits of having this like funding short is like, well, if NVIDIA does go down, then it still helps them on the downside. So that's something that I wanted to touch upon, because if people are wondering, like, why is NVIDIA doing this like weird, funny movement sometimes? Well, it's very popular funding short, extremely popular. Okay, so that's just, let me go over, see if there's any questions on this. Long-term agreements, LTA, long-term agreements. So China memory, the argument around China memory is the one of the funnier ones, because on a consumer side, China memory has a point, right? Where yes, but on the commercial side, forget about it. That's funny. So these people who think that Chinese memory is going to find itself in commercial grade data centers. Oh no. So on the consumer side, I could see like low end consumer products definitely use it. But I'll give you an example. Like Apple was like they thought about thinking about using it, and they were immediately told you are not allowed you were definitely not allowed to use that. And like, okay, fine. So that's like on the consumer product side that matters the most, which is iPhones in the West at least. And then when we're talking about data centers, commercial grade data centers, like from the not even neo clouds, but from the hyperscalers, forget about it. Literally forget about it. And then there's actually meaningful differentiation at the high end of memory. So we're talking about HBM. So like SK Hynix is still actually the leader. So there's actually formed some differentiation. But what you're talking about is actually in the more commoditized side of memory. But on top of that, there's like other barriers that are not simply cost or price. And even then, when you research further and peel back further, remember there's the hype. You follow some of the folks that actually work or study memory, and they'll point out, even their marketing of what China says they're achieving isn't necessarily true. And you will see it, like I said, you will see it, and your little computer, your cute little computer that you build for your gaming. You probably see it there, and like, oh yeah, you can buy the your RAM again, and you'll be happy, right? You'll buy a little Chinese RAM and you'll be happy. But you're not going to see it in the stuff that actually matters, or the stuff that actually makes money. So it's kind of a funny thing. It happens. It always happens. Probably soldiers are going to get whacked for Cuba. Yeah, the Cuban invasion. I'm not Cuban though. All right. Does the outlook for next year? Oh yeah, not joking. Didn't you say Andrew pumped and dumped trucking, buddy? You didn't think I forgot, did you? Does the outlook next year look better for NVIDIA 210 or Oracle 190 currently? Oracle has more torque than NVIDIA. There's more narratives around it, but so I guess you're looking for more torque, Oracle. Will NVIDIA have a run up like Micron? NVIDIA already had them run up like Micron. So Micron's having a run up like NVIDIA is how I phrase it. That's why NVIDIA is a great funding short. Because the funds in general understand that NVIDIA is unlikely to have a Micron-like run. So an example of like, perhaps some funds out there have done this funding short NVIDIA, long Micron, right? Pre or in the midst of Micron's parabolic move. And what you get for that is you get, you get the profit, the delta between the performance of NVIDIA and Micron. So again, funding short. So NVIDIA, no one expects NVIDIA to have a hyperbolic move. If it does, it will wreck a lot of shorts. Like if NVIDIA goes and like 10x's from here and becomes a $50 trillion company, and again, the thought process is like, is it likely that NVIDIA becomes a $50 trillion company? No. And so makes it a decent funding short. So a lot of people are doing that. Anyways. Your trade on NVIDIA is what nobody special thinks NVIDIA does. My trade on what is your trade on NVIDIA is what nobody special thinks NVIDIA does? What does that mean? Okay, lots of questions. Holy shit. Thoughts on Steve Eisman being short FICO? One of my contras is long FICO, so I'm like, fuck, maybe Steve Eisman's right on this. So yeah, you've definitely already talked about this, but I missed it. What's this STM thesis? So disclosure, we're long STM at much lower prices, and STM you're getting basically a couple things. So like satellites. satellite tech, I should say, for some semiconductors and satellites, and the energy semi play 800 VDC, the change in architecture next year, etc. So the market's already moving ahead of that. Probably still has more room to run. But yeah, that's elevator pitch, STM thesis. It's at the middle of a bunch of different themes all at once. So could continue to get more and more and more and more hype potentially, but we'll see. And I'll if you want me to tickle your fancy on like hype names or not hype names on not trigger words, that's the wrong word, on buzzwords. So you got robotics in there, you got self-driving vehicles, you got data centers, satellite, all that's in STM. And if the market regard folks start to catch wind more of STM like that, oh my gosh, I could see that thing just like get hyped to kingdom come, overhyped potentially. But they're a cyclical business. They already hit trough earnings. They're on the upswing right now, and so a lot of sell side because I know I'm going to ask this, like, oh, but if I go on Seeking Alpha and I go on the earnings and I see the future earnings, you look at the sell side estimates. Oh yeah, you've done all the research, bro. But sell side's also wrong on this. Again, sell side gives you an idea, and if you rely on it too much, like you do you, good luck. But there's plenty of buy side research, which tends to be more thorough, but sell side research also thorough. It's kind of also funny to see like how in some cases, like the sell side research from B of A, they're like, they don't even mention some of the things that we're bullish on. They only talk about the satellites. And I'm like, okay, the satellites is like cool. Like, yes, it's going to do well on the satellite front, but like, you're kind of missing this like whole other thing that is going to drive earnings a lot potentially. We're very confident that it will, but I'll say potentially because it's not here. The satellites are here, and they're getting a lot of business with SpaceX and Project Leo, etc. Okay, so thoughts on Microsoft or Meta? Both are cheap. Meta's cheaper. Meta has probably more torque if narratives change. I think Meta actually had a little bit of a run today. Disclosure, we're long Meta. Maybe I should say that. Disclosure, we're long Meta. But yeah, oh, look at that. Meta had something happen. People decided randomly. It's like, oh, I need to buy Meta. I haven't caught up. There could be news. If there was, I literally didn't see it. Let me see. Meta. Okay, both are that's some fucking random noise. Okay, no. The new Meta One subscription span, Instagram, Facebook, WhatsApp. Okay, so they're monetizing it different. That, I guess that could move it, I guess. I love you too, random citizen, to quote a movie. Fabio, with energy being so sought after, the industrialization theme of the United States is so yes, solar. Solar is going to do well, man. It has been doing well. It's going to probably continue to do well because I think it bridges a lot of the gaps in some of these other energies, and it's cheap enough and efficient enough these days to actually make sense. So a lot of things have changed in the solar industry that are not true a decade ago. So people who are espousing a lot of the random shit about how bad solar is from a decade ago, that it was true a decade ago, a lot of that's changed. And yeah, there's a lot of very interesting plays in solar. And you remember when we were used to make fun of like, the Solar Edge and Enphase, etc. No, a lot of that I have to change my mind on because, well, this is the first time we're talking about it publicly, but Solar Edge, interesting. Enphase, interesting. And if you followed Capital Minds for a long time, you remember back in the olden days, old Capital Mindset, like, 2021, we're like, these are retail shit codes everyone's hyped up about, and everyone's buying the dip and getting fucked. Now, the businesses have changed where they're focusing on the right things, the microinverters for utility scale products. And so, what United States is doing, investing in the grid, et cetera, they're right there. So yes, solar's gotten a lot better, and I would be bullish solar. We currently, sadly, do not have a position in it. Maybe we need to fix that, Andrew. But yeah. What do you think about Lumen as a play for connecting data centers? Yeah, it's more speculative. Yeah, more speculative. Has a lot more of a run up. Yeah, there's been. I think CN is another good one. CIEN. But yeah, connectivity data centers. Yeah, probably. Once 5 years out, I'm out. Yes. We're mortals of the great genius. Nobody special. Yeah, nobody special is something special. I'll say that. At current prices, most attractive names come to me now are Amazon, Melly, CSUTOI, MA, and Reddit. What's my best and my worst pick of the group? Okay, so Amazon's already gotten some love. So Melly near term, the only issue with Melly is you have concerns about demand destruction actually happening at the third world level because of where oil prices are at. So we went over this in the last live stream on the effects of what happened with energy prices, how that might not cause demand destruction in first world nations like the United States, but can cause demand destruction in nations like Latin America, all the nations of Latin America, and that affects Melly. So that's one concern, but long term, I'm bullish Melly. So if you have a long term vision, Melly looks good. Short term, you could have pain, underperformance, might not do much, might do if we do see alleviation in energy. And I think energy really is a tailwind for Melly if energy calms down. So that one could have some torque. And if you're defining it like probably by total return potential, I'd put Melly up there in terms of long-term total return potential because they got a lot of things going for them. I put Amazon as decent to good return potential, not like blow your socks off. Reddit, I don't know about Reddit. So Reddit's already going down to one of the bottom of my list. I just don't know much. That's kind of why. And then MasterCard. So MasterCard's got that international main exposure. They have some US, North America exposure, but international is really their where they edge over Visa. MasterCard, I don't think there's a lot of there's not a ton of future growth in MasterCard, but it's a solid, lower beta pick. Actually, I don't know what the beta is on MasterCard off the top of my head, so it might not. I think it's lower beta. But what I mean by that is like it's a steady blue chip. You could do way worse than MasterCard. Great quality business, etc. Underperformed recently, could have a snapback, and I think it will continue to grow, respectably in the mid-teens. So I'd probably say worst Reddit. But I'm going to be clear with you that Reddit's coming out of a point of ignorance, unfortunately. So maybe if I remove Reddit from the group and because I can't comment too much on Reddit, so I'll be more honest. So let's ignore Reddit. I probably say, CS, and I like them, by the way. It's not that I hate them. You put in front of me all these companies are like, you know what? I'll say MA worst, and the best one for probably highest torque long-term Melly, and then Amazon CSUTOI in the middle. But reason why I went with MA at the bottom is only because the growth days of them growing past 20% are probably behind them, and that's not their fault. It's just they're so big. But it doesn't mean they're a bad company. I removed Reddit because I don't want to be lazy and throw Reddit at the bottom. But that was because Reddit, it comes out of ignorance. Like I just don't understand the business. I don't understand if they're gonna, get to the same monetization rates as even close to Meta. So, but if you force me to throw Meta or Reddit in there, I would put Reddit at the bottom, everyone else in the middle. And then Melly potentially closer to the top. Maybe swap it with Amazon if Amazon surprises me in a few ways. But Melly is a lot smaller than Amazon, so a lot of large numbers. Amazon has to impress us even more. I mean, Amazon's probably a better business than Melly, but Amazon's also already a $3 trillion market cap. Melly's under 100 billion. And so, you know, for Amazon to double, it's going to take more than for Melly, in my view, to double. And then CSUTOI, actually, if I rate it on uncertainty, I think MasterCard would go over CSUTOI. But CSUTOI, because I'm currently in the camp that VMS is going to be fine, and that in the future they're going to get even better prices on some of their acquisitions. That's going to fuel even more growth. You know, I like them, and so I think they can actually grow more than MasterCard, and they're trading at a cheaper valuation than MasterCard. So that's kind of where I edge out. But I'm more certain that like MasterCard's going to be here and going to be fine and not disrupted, and stable coins, blah 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 blah, it's going to be fine in the next few years or the next decade. So, anyways, long-winded answer, but I wanted to spend time on that to give you a fair answer. I already forgot what we talked about. What the hell did we talk about? What the fuck was your? STM. Keep up to date with it pretty frequently, but it could be, yes, depending on how the numbers check out. But it's not something you just don't babysit. You need to babysit that. I think he's saying funding short from NVIDIA to buy long AI names, kind of like, oh yeah, okay. And he says, thank you, Andrew. So that's definitely what he meant. All right, I regret not pulling the trigger on Snow. It's up. I don't. I mean, yeah, of course. If I had the crystal ball, you know, I would do it. But no, I don't, because I wouldn't have done it for the right reasons. It would have been complete luck. I don't know anything about it. Or I don't know anything about it to make a reason why like they're better than Databricks when Databricks goes public later this year. But yeah. Zoetis Vital Farms. Vital Farms, I'm not sure where they stand on the totem pole of branding anymore. There's like I buy Vital Farm eggs. I don't give a fuck. But like, funny enough, at the risk of sounding like, I don't know, cringe or whatever, my masseuse, they're not a stock person, but we chat, right? And I don't know how the conversation got to like eggs and like Vital Farms. They had a horrible opinion of Vital Farms. I was like, oh my god. So yeah, I don't know, but that's anecdotal. But if you look at social media, they're kind of getting canceled right now. I don't know if that stays. I don't really follow the social media chatter on Vital Farms, but that's something to think about. And then Zoetis, I couldn't tell you shit about, you know, pharma for animals. I don't know. Maybe I asked like biotechs like what he thinks, but like I don't know if what are they doing, like a dick pill for a dog? I don't know. So yeah, I can't comment on either, to be honest. But if I had to pick one, you put a gun in my head, I'd go Vital Farms. I'd be like, oh, I kind of understand the egg business. You know, I've analyzed Cal-Maine Foods before, so I get the idea of what they're selling, what the market looks like, the cycle, what it looks like, the premiumization of their product. You know, they have good balance sheet. I couldn't tell you anything about the pipeline of dog boner pills. Like, you know, I know that's more to be a joke, right? I know they obviously don't have dog boner pills. Maybe they do. I don't know. But yeah. Oh, I don't demonetize. Yeah, okay. That's comedic relief. You know, you need a break. You've been listening to me for an hour. You need to laugh a little bit. Meta or Microsoft, are they? I already told you, Meta's a little cheaper, but they're both great. You'll do great with both. I should listen to my own instincts sometimes. Missed on Snow this time. Yeah. And I'm not gonna get those. Intuit Toast, Coupang ranked from best to worst. You guys are talking about the hierarchy, right? Well, you know, Intuit did go down. Toast, Intuit, close, Coupang last. Why is Alp growing so fast? Because it's OP. It's a great product, and the guys at Turning Point really know product distribution. So got to say that. All three have beaten up pretty bad. Yep, they've all been beaten up pretty bad. But yeah, that's the list I'd go. And I started to look at Solar Edge, not Enphase. Need to understand their businesses better. Might look into the starter position. So Solar Edge has a bit more of an edge, pun intended, on the utility scale products. Enphase, less of a utility scale product edge, was more on residential, has been switching over. Hence why you've seen for Enphase the violent move recently, while Solar Edge, the move has been much more over the past year. So you see, like Enphase, the story's really changed very recently. And then Sedge, if you look past the 1 year, it's grinded up 300 some odd %. So they were already positioned well and are just getting the benefits. Enphase recently made a pivot that the market is then responding to. So pick your champion, I guess, there, but both will do well if you're a believer in solar having a meaningful need or desire or demand in data center capex. So I think you'll do well with either. It's just like so hot right now. Bio told us Vero. I don't even know about Vero, but yeah, listen to Biotex and the other guys in the server who are, focused on pharma. Just ask them. Any feelings on Amphenol? It has such a large footprint in data center and electronic buildup. No, sadly, no opinion on Amphenol. I know it's one of the hot stocks that people are talking about, but I haven't really been able to look at it. See, there's so many ways to play this, and I'm not going to get all of them. Yeah, I just got demonetized. What's your thoughts on the new IPO stocks, CRBS? It's interesting on watch list. No opinion on valuation right now. Dog-borne pills, market going fast. Hell yeah, it is. Thoughts on Energy Fuels here. So I'm assuming you're talking about UUU. I like it. We're long UUU, spec position. So UUU, say that 5 times fast. But yeah, we're long Energy Fuels. So full disclosure there. Again, we have a speculative position, so don't get all excited about it. But I think it could do really well. What UUU has focused more is on the refinement side. And they have some uranium exposure, so you get that little bit of story pickup there. The U.S. basically told you what they want. They want to refocus on building some of these supply chains for rare earth minerals and critical minerals. I'll go over the presentation that I gave. I didn't share the slide with you. I shared some of the slides. I didn't share all the slides. So this was part of the presentation I gave in Capital Mindset. I gave it also for our investors. But I'm just going to use one slide here just to point this out, like what we were, talking about. So, and this kind of comes together with our, some of the thesis around like what's happening with reindustrialization, et cetera. But I want you to, your eyes should go right down here. So right down here. Okay, so part of the verbal commentary I'll provide on this is like, okay, well, what is the domestic supply? Critical. Sustainability. Substitutability. None. USD pricing, yes. Income buffer, high. Net resilience, critical. US government looks at this and says, oh shit, we need to fix this. US government tells you, we want to fix this. All right, so then you have a bunch of plays that kind of play into that, and they're right position, right time. It's their moment, right? So this is their time to shine. If they're not shitcos, if they're not complete garbage scam, they'll do very well, right? This is their time to shine. They're going to get propped up. They're going to get money from the tits of the government, so that they thrive in some capacity, and we have localized supply chains for something that is extremely important. And for those of you who don't know, on things like MP Materials, which is the other big one, there's USA something, that one's the more shit code, to be honest. And then Energy Fuels, they have a little bit of a different flavor. So MP Materials is much more on the magnets, rare earths, but magnets. And they've done something really smart where they've focused on that. And the magnets are actually really important for industrial use cases. UUU is going a little bit of a different way. They're doing a few things. Uranium's in there, so nuclear, but also the refinement itself of rare earths, which is actually the rare part. So people, again, you probably heard this by now, but some people maybe haven't heard this, but you probably heard the phrase like rare earths are not rare. It's actually just the refined. So their pivot towards that puts them in, they're kind of occupying the actual difficult part of the whole process, which a lot of what's difficult, it's not as technical as like semiconductor manufacturing. It's like not like they're doing what TSM does, but it is technically difficult. It's not the easiest thing to do. And what the hardest part of it all is getting the proper permits in place, making sure like, you can build these facilities, and it takes time. And so that will provide at least some moat for the foreseeable future. But to be very clear, this is all early stage. So you're not buying a company with like gushing profits, et cetera. You're buying a story. So as long as you know that when you're getting involved in this, and you allocate appropriate to your own investment desire, and I'm investing in a story. I am not investing in a set of cash flows that I can see right now, because you can't see any of that. I'm investing in a story. But that being said, I like it. We have a position. It's a speculative position for us. Hopefully that answers your question. But yeah. Fabi, do you ever invest in no? Flat out no. I have in the past, and I got lucky because the more you know, especially on like that, you're like, damn. Granted, one of them was a blue chip. It was AbbVie. It was way back in the day. This was basically they bought a company called Allergan, and that Allergan acquisition, Abifeliton. I looked at it. Well, I did ask around from the folks who did know, like, okay, what's their pipeline like, et cetera. But I had no business investing in it. So I made money. That was luck. And then Vertex Pharmaceuticals, that was luck. But like, I don't really know what's going on in biopharma. So no business. So I don't play in there. Definitely the fund, we do not touch that. It's fine if I have a little in the past. I don't even do it now, but like in the past, it's like, it's perfectly fine if I gambled my own money on something I didn't really know. But yeah, I'm not interested in biopharma. I can make money without biopharma. Now, med tech is a lot easier to understand. We have the resources to better understand that. Talk to the experts we need to figure out like, okay, what's the differentiation here? So that's not outside of our universe. Med tech is actually getting pretty interesting. At least there's some names out there, but biopharma is just, I'm not, especially the small stuff. I could foresee a future where like, if some of the blue chips or like the sector, we play like a sector play to try to like, capture, biopharma is completely out of favor, so we'll buy like an ETF. Like that's something I could envision us doing, but it's not something active in conversation. Okay, thoughts on Netflix going back to 87? Oh, Netflix on the watch list. But yeah, Netflix at a certain price, definitely nice. Previously you mentioned, I think is very sure thing bet trading at a fairly cheap price. Okay, so I'll correct one thing on that, because great part about the network that I've been lucky to build out, learning new things. My partner has actually really good network in this space, and one thing that was pretty insightful is like what's keeping the people in this industry up at night. And I'll share it with you so you can think about this for your own thesis. So part of what makes Arthur G. Gallagher, Brown & Brown so attractive and profitable is when I get new business, I get a commission, right? So I'm your broker. I'm the insurance broker. I get new business. I get a nice commission. But when you renew the policy, the work that I have to do as the broker, and therefore the operating cost on that is so low, but the commission's the same. So from the broker standpoint, that's amazing. So it's really the most upfront cost is the new business. And then everything else after that is really profitable. That's what's really attractive about the brokerage business. They all grow through acquisition, so let's put that to the side. But really, just talking about like, what is the threat? What is keeping everyone in this industry up at night? I don't know if the market is thinking that. I have no idea what the market's honestly thinking. The markets could just be, well, we traded them at like 30 plus times earnings. Now they're back to normal, but they're back to like 2008 time levels. So if you don't think this is a risk, then not full speed ahead, but these are really attractive businesses. But what the concern is, right? And you can already kind of guess where I'm going with that. Well, what happens if, I don't know, insurance companies start to say, because tech is advancing in a way we don't really understand the true implications of it for some of these business practices. What if they say, why am I paying you the same commission for a renewal of business? Like, why am I doing that? Why are you making all that money? Am I able to, not give you some of that money? And so that's something that actually does keep a lot of these industries up at night. But to the demand that they fulfill, there's still going to be a need for that. So it's more of a question of like, well, the margins get impacted. That could be dramatic, but a dramatic impact on margins, but they're still alive. They still exist. They're just making less money than they did before. And there's always going to be a need and demand for people at firms to work with someone and work with these brokers who can help them, navigate the complexity. And it's a question of like, do they have the ability and pricing power to maintain that current economics that are very attractive or not? Maybe they do. If they do, they're very attractive at this price. If they don't, that's a problem. And so maybe the market's sniffing that out. Maybe it's not. I don't know. I really don't know. I couldn't tell you like what hill I'm dying on there, but it's something I'm thinking about and something you might think about. So maybe you didn't think about that before, but now food for thought. So it's something to investigate. And if you come back to the table and say like, yeah, I looked into it, that's not likely for this, and this reason, and I'm willing to put some capital behind it. Yeah. And if you're right, you'll probably do really well. But yeah. What's the moat? Yeah. So the moat is in the relationships. Once you establish a relationship, you're probably never leaving. That's why a lot of them grow through acquisition. So if you ever wondered that, like, why are they not there? There's some organic growth, but like, why are they mostly growing through acquisition? That's why. It's like once you're using them, you're just going to stick with them most of the time. Like you build that really tight relationship. They're managing all your insurance policies. You don't want anything to change there, but yeah, that's the moat. It's a relationships moat. On silver or gold, will be going back down, or is this the new normal? No, silver and gold is probably not going back down to the old prices, but silver and gold, believe it or not, are more liquidity vectors than anything else. Like when liquidity is ample, silver and gold do well. So people think of it as like a hedge against the stock market. It's not really. They're much more correlated than you might think. It has much more to do with liquidity flows and the like. But when you see like liquidity contraction or liquidity crunch, that's actually bad for gold, not good for gold. That's bad for gold. Because people still don't respect like dollar flows and bond market, etc. But anyways, thanks. So you're interested in next pill for solving something you should invest in? Hey, if you walk me through like I'm a 5-year-old and explain to me why this pill is so important, I'm all ears. And if you can actually give me an understanding, I could be convinced. But hey, you got to help me understand it better, right? I'm just telling you my weaknesses, and that biotech is like one of them. Biopharma, I can do fine without it, but yeah, I'm not gonna say no if you hypothetically give me the golden opportunity and like the I don't know, this pill cures cancer and grows your PP and makes you like IQ plus 70. Okay. I'm not going to say no if that existed. That'll make a ton of money. But you get what I mean? Do I like Powell? Okay, so Powell, man, the valuation's insane, but yeah, I like Powell. I like all energy infra plays. So yeah, I like Powell. There's a lot of ways to play energy infra. That's one of them. They're much more contract based. So shit hits the fan, they're gonna get absolutely fucked. But for now, they're not. There's no sign of them getting fucked. Thoughts on Take-Two Interactive? Not sure why it dropped so much after earnings. buy the rumor, sell the news. Now we know when GTA is coming out. So buy the rumor, sell the news. That's all I can say. I mean, that's what I think it is, but I don't keep too track or too close to it. So we're a little late on the last discussion, but I went into a bunch of stuff. So I'm going to change the timestamps to reflect that. And we are going to start talking about consume. You must consume. You must fulfill your purpose. What is your purpose? It's to consume. So quick, consume. All right. So let's talk about what's going on with consumer. What do we have reports for? What are they talking about? Right. And what do I think about the consumer? All right. So let's start with the reports. We got a bit of a mixed bag. What I mean by that? Well, if you listen to Walmart, consumers fucked. But how do we know that that is noise or signal? Well, I'm not going to bury the lead. That is complete noise. Why is it complete noise? Well, go listen to Walmart going back all the way to 2022. I know this because in 2023, I covered Walmart's earnings quite a few times, talking about how doomerish they were. And at the time, I was like, okay, we just exited 2022. We had a technical recession. We had, in my view, on the old economy, a real recession. And Walmart's telling me the consumer's weak. So naturally, I go, oh, consumer's weak. But we go a little further and further and further. And we continue to see a divergence happening. Walmart, Dollar General, and Dollar Tree, we're saying also something similar. Consumer's weak, yada, yada, yada. We don't hear that really from Amazon, though. We don't hear, but it's not that Amazon or Walmart's numbers were bad and Amazon's numbers were good. No, Walmart's numbers were good, but Walmart's telling me this. The banks are telling me that. Visa's telling me what the banks are telling me. Everyone who actually sees the consumer balance sheet is telling me what, the consumer's fine. And then what I, come to realize is that, yeah, Walmart definitely has been like noise the whole time. If you invested in accordance to the belief that Walmart had the best picture of the consumer and the consumer health, you would have been ass blasted on consumer stuff. As you would shorted the wrong things, went long the wrong things, and yeah. So and like Kraft Heinz, I believe in their report, they said the consumer's fucked, but the Kraft Heinz thing, you can go back all the way to like 2017 and before. Like a lot of the consumer staples companies have had this issue. Campbell's Soup is going through the same thing, but since Kraft Heinz's re-IPO, it's been a shit show. That lack of investment in products, they're just losing. But you have other businesses that are showing same-store sales growth, plenty of same-store sales growth. Starbucks, et cetera, is showing same-store sales growth again, for example. And then, changes like people are Uber eating, door dashing. There's a lot more discovery of non-public restaurants. Toast also reports on like restaurant activity, et cetera. So we're living in an age where a lot of these companies that maybe had less competition because their competition had lower discoverability, there's a lot more discoverability. It's never been easier for me to pick up my phone and find a new restaurant. Super easy. The convenience factor is gone in most cases. Again, delivery apps have changed this. The adoption of delivery apps and more people using them has also changed this. So while before the pizza delivery like Domino's had an edge on convenience because they were the things that delivered. Now anything can be delivered. I can deliver a steak dinner to myself. I can deliver a pasta, whatever I think of, I can deliver it to myself, or I can have it picked up. Or I can just discover new things. And tons of this sort of like improvement in discoverability is my view on like why some of these slop bowl places or slop restaurants have just kind of suffered a little bit. If they're not adding some sort of extra value, why would I spend $12 at your shitty burger place when you're a chain or whatever, and when I can go get a $12 or not even $12, $14 more expensive burger, but I pay $2 more for a much better burger, as an example. Maybe some of you feel that anecdotally. I know when we've talked about this a lot in Capital Mindset, a lot of people are like, yeah, I actually do see that a lot. Like, I now don't even think about, going to, whatever, McDonald's. Cause like only if everything is closed, I'll go to McDonald's, or only if blah, 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 I'll go to this name, insert fast food name. because I'm actually using, or I have the app and it like tells me about this new restaurant and I just like go check it out or whatever. Point being, there's a lot of different companies all saying different things, and my view is like some of the companies that are suffering right now consumer wise, they're coping. We listen to a bunch of the recent consumer discretionary companies. Abercrombie and Fitch actually just reported, disclosure, we're long Abercrombie and Fitch. Like, it was trading at 5 times earnings. It just needed to not do shit, and it got rewarded. But Urban Outfitters also reported. And so like we're seeing even on these retail names, consumers doing just fine. The companies that would actually know if consumer is doing poorly, the banks, the consumer banks, we're not seeing anything, crazy. But a lot of people out there want to sell you doom and gloom. They want to be like, yeah, consumers fucked. Consumer sentiment survey, look at this. If you're quoting this consumer sentiment survey, you're kind of a clown. Not if you're not, in the industry. You're just like an onlooker. You're fine, because like you're not, you're just like, I don't know, a passive consumer of this content, and that's fine. There's nothing wrong with it. But if you're someone who's trying to be taken seriously and trying to use it for your investment purposes, for your clients, etc., complete clown. There's so many problems with the consumer sentiment survey, and in fact, it's much more noise than signal. Even in some of the not too distant past, it's been more noise than signal. If you shorted consumer stuff at the bottom of consumer sentiment, like, obviously, what are you going to do with that information? In fact, it just tells me, it's like, if I were to believe this, I should be going long, because usually it signals closer to the bottom than some sort of top. But anyways, consumers doing just fine. We're seeing really robust resistance, and again, people cope with, like, they changed move the goalposts. Like, economy's doing fine, consumers doing fine, but it's a K-shaped economy. It's like, also not necessarily the case. I mean, we're seeing a lot of again, the companies that would know how the low end consumer is doing, like Dave, they would know how the low end consumer is doing. They have good things to say about the low end consumer. Like, the low end consumer is granted in permanent recession. That is, by the way, what it's like to be poor. What is it like to be poor? Well, being poor is being in a state of struggle, constant state of financial struggle. So if I ever hear the words, poor people are doing economically fine, then they're not poor. but if someone is poor, they're not going through easy economic times, because they are poor. And so it's like, go figure. Of course, that's going to be the case. What we really care in terms of like the real impact of consumption, we're talking about middle class and higher earners, all that spectrum. The low end is always going to be doing poorly. They are poor. This is not new information. And what we're still seeing, again, within that framework of understanding that poor people are struggling, because they always struggle, because that is what it is like to be poor. The companies that would know how they're doing, they're giving us constructive feedback on the fact that they're not doing as worse as other times, right? And so that's a spectrum of doing poorly. But anyways, circling back, like, again, I try to look for it, because like there's people on X that are a bunch of clowns who are like shouting doom and gloom on consumer, and I'm just like, where are they getting this from? So they'll look at a firm and they'll say like, oh, a firm is lying completely. They're fabricating the numbers. That's like cope. That's the biggest cope I've ever heard, because instead of trying to allow the data to guide them to the conclusion, they made the conclusion up. They put their online persona and personality behind that conclusion. And for some reason, everyone's in a frenzy. It's that, I always forget the name of that phenomenon in economics, where you interview people, you ask them, hey, okay, wait, but okay, no, we're going to get to you, Sam. We're going to get to you, Sam. You can't say that. You can't be poor and then follow up by saying, okay, anyway, that's not being poor. Anyways, coming back to, sorry, just the comment distracted me, because it's an oxymoron a little bit, but instead of allowing the data to change, they attach their online persona to a narrative that they've already pre-concluded, and then so everything goes to just proving that narrative, even if it contradicts itself. So an example which was made us laugh our asses off, which is one guy who streamed, I won't say his name, but he said something along the lines of, if Nvidia goes down on earnings, it's because, and the earnings are good, is because everyone knows they're fraud. But if Nvidia goes up on earnings, it's because no one knows they're fraud. I am not joking with you. That is a quote. I am not joking with you. That is a quote. So I'll repeat that to you one more time. If Nvidia goes down on earnings, it's because everyone knows they're fraud. If Nvidia goes up on earnings, it's because no one knows they're fraud. Like, okay, cool. Anyways, apparently the United States struck Iran and futures are down from the strike tonight. So yeah, markets have been kind of hot. So like we need a little bit of pullback. Who knows? You just need like a little push for something. Markets have done stupid well. The U.S. striking Iran is honestly what, and people forget like what happened in previous conflicts. Like you do have an initial like panic and freak out. It's just a wealth transfer moment. Hopefully you guys, I know my audience, you guys are, pretty stern, but like just look at them as wealth transfer moments. It's not Michael Burry. No, it's not Michael Burry. Michael Burry has been honestly a little bit more constructive with it because we talked about this here on the channel, like my disagreements with Michael Burry on his arguments. We went point by point and why it was completely incorrect, or at least in our opinion, it's incorrect. I won't say definitively incorrect. In our opinion, gold is getting killed. Oil is back up. All right, so let's. I'll take a look at oil in a second. Oh, okay, like when we say oil is back up. Oh, I guess this cut off. Yeah, this cut off there. Let's go in the futures here. We'll just use. Just get it quick. Yeah, markets are. Oh my gosh, markets are down a ton, boys. It's over. Yeah, so S&P futures are down 0.35%. NASDAQ is down 0.78%. We're all cooked. But anyways, let's look at commodities. Brent is, oh my God, it's so funny. Oh shit. It's so funny that, well, we talk about why Andrew might be interested by that podcast that I listened to. Oh no, they were the contra the whole time. The timing is amazing because they reduced a ton of their energy exposure because they were so frustrated. Oh man. But we'll see if that holds because it would just be so funny, wouldn't it? Snow's up $61 on earnings and after hours, but I guess we'll open low. Really? It'll open lower than the price it ended today? No way. Really? Oh, we'll talk about Uber in a second. Great question. I was already asked about Uber. I'm looking at Grab and wondering if you have an opinion on their financial services section or any place to check more info. Love Grab from just a business standpoint. They're pretty weak right now because you got to understand like what the market is worried about. So hopefully this like helps you out with your thesis. Market's just concerned about third world demand destruction. So we talked a lot about that in the last live stream about, why will oil not go to $200 a barrel? A lot of it had to do with, the effects of demand destruction in some of these poor countries. So I'll share like the slide deck or one of the slides from the slide deck that we talked about. So like this image basically encapsulates it. So supply tightens, price spikes, marginal buyer exit. So the marginal buyer, what you got to think of is Grab's market. So Grab services Southeast Asia. So this marginal buyer, price of oil jumps too high, their incomes are a lot lower, they're out. What does that entail for, Grab's markets? Less consumption. We call that demand destruction. Now, step 4 doesn't pertain to Grab. That's more about the US. But at step 3, think about what's happening there. So we're looking at that and saying like, okay, the market's actually concerned that Grab, and we'll put up Grab here. Grab's markets are in a lot of pain. So if you're patient, Grab definitely survives the other side of this. And they're one of the cleanest ways to capture the economic growth and prosperity, future prosperity of Southeast Asian countries. So I think they're a great way for you because they're traded on the NASDAQ, et cetera, but great way for you to just like plug your nose, buy it. And if you have patience, I think you'll do fine. I think it'll be a longer term winner. But yeah. Yeah. Again, there's a live stream. I said this publicly on like Trump. Trump is the unreliable narrator. We talked about this. I don't know why everyone keeps getting surprised by it, but as long as the adversaries aren't surprised by it, then it keeps working. But he's an unreliable narrator in the sense that he says a lot of things, and you can't really use what he says as signal for what is about to happen. You have to use other means to figure out more or less what is about to happen. That's why it perplexes me that it keeps happening, that he's utilized and people keep forgetting unreliable narrator. That means that in an unreliable narration style, the narrator will tell you things that are true and tell you things that are not true simultaneously, and you have no idea which ones are which. And you can use context clues, just like in a literary analysis. You can use context clues within the literature itself to figure out when the narrator is being unreliable or not being unreliable. And sometimes it's hard to use the context clues, and sometimes it's easier. And a lot of times you have to wait for hindsight to figure out, okay, like, I'm later on in the story. Now I know what was unreliable, what was not. And in some cases, for some works of literature, it's like, you'll never know. And that's the whole like fun part about it. But yeah, with Trump, it's like, he says a lot of things. Some of them are true. Like, he's going to tell you what he's going to do. And then other times he's telling you something that's not what he's going to do. And you do not have the signal there to actually act upon all the time reliably. But you can use context clues. So things other parts of the government are saying to get an idea of what it was. And posture wise, the United States was still in a aggressive stance towards Iran, and it has greater goals, wider goals than simply, oil price go down. In fact, the United States has benefited tremendously on the global stage from what's occurred. If you look at, what's happening with manufacturing capacity, the U.S. has now presented itself as the most reliable place to park up your manufacturing. Basically, you got cheap energy, and no one's going to attack that energy. And so you don't have to, rely on Middle Eastern oil that, oh, it's all scary. And people will extrapolate, because they always do, extrapolate what's happening now to be like what it will be in the future. So we'll probably see a wave of this movement. And eventually, like, Middle Eastern oil will get back to, like, being calm and reliable, but not before a lot of people have this like whole, fear about that ever happening again. And it's probably not going to happen for a long time after that. So yeah. So great point. Have you ever heard of Canadian SaaS? Yes. Descartes. Yeah. So logistics software. Yeah. I'm pretty autistic in that I know way too many tickers. So yeah, no, I've heard of most companies. It's actually now a game of like, if I haven't heard of a company. Yeah. So same thing with all of these, like, VMS software types. Yeah, no, don't hate it. I like the guys over there. I think they've done really good job. I think Constellation Software and Family is a more flexible, dynamic in the sense that they don't just focus on a niche. But I love companies also that focus on niche, like Descartes, Tyler Technologies. Roper is industrial too, but they've kind of veered off into like campus software, things like that. So yeah. Probably a funny question. What do you think companies like airlines are publicly traded? It seems like there's no value in return to shareholders unless you pair a credit card with it. There has been periods of times where they have done well. It's just like they got really fucked from COVID, man. You got to remember that there was like right before COVID, there was a sort of like change in the trajectory, and like COVID really fucked them. But a lot of them have since recovered. They got to manage. I think the solution, because one of the best performing airline stocks in terms of value was like Southwest for a very long time. And if you actually looked at, it's about managing your balance sheet well. I think that's the problem with a lot of utilities, like telecoms. So I all of them have the same tactic, and I feel like one of them should just do it differently. I think actually T-Mobile is the one who did it differently. Yeah, never mind. There is one, T-Mobile, and they actually outperformed. Go figure. But also, no, there are some international telecom companies that have done the same playbook where they manage their balance sheet a lot more. And in theory, financial theory would tell us that your cash flows are relatively stable because you're a utility, and so you can lever the fuck up. But I find that in practice, it doesn't actually lead to the best shareholder return. And in fact puts you in precarious and or dangerous situations at some point in the future that you cannot predict. But in theory, on paper, in the textbook, it would suggest that you should lever up. You should have like this optimal WACC or whatever. In practice, in the real world, the theory tends, I haven't seen it really be that successful. The only ones that the only business I can think of off the top of my head that manages to hold tons of debt and leverage it, and the creditors are super happy, is like TransDigm. TransDigm is unbelievably loaded with debt, but their businesses have immense pricing power. Utilities don't have that kind of pricing power. Utilities have stability, they do not have pricing power. So when I look at companies like Verizon or Charter Communications, it's like, okay, in theory, they should obviously, yes, be loaded with debt. In practice, what I think we end up seeing is, well, while times are good, you look great. Tough time comes. Oh shit, now you're in trouble. So you got to service all this debt, yada yada. You can't really grow. The lack of flexibility. So take Fiserv as another one. That's an example. We talked about this exact problem with Fiserv right before they crashed, right? And you can see like they have a lot less options. The management team there at Fiserv now is actually really competent. But my problem with Fiserv, of course, is like very seldom do we see companies that pay their debt down per se, and it's just like does well without them growing their way out of the debt. So you have to typically the names we see that is a deleverage story, and they're successful at deleveraging and generating a lot of returns. They're growing their way out of the debt. So some examples like the Israeli Teva Pharmaceuticals, the Swedish guy who took over CEO there back in like 2017. Or 2017, all the years are now blending together. But back in before COVID, he took over and he stated a plan. No position in Teva. I fucked up because I literally been watching that company forever. Stanley Druckenmiller bought it and he made money on it. But literally, he's done a great job at the transformation. But they sold off the businesses that didn't make any sense. But their core business was growing, so they grew their way out of that debt, and now much more manageable. Etc. And there's a few other examples we could get into, but for the sake of brevity, because I'm looking at the time now, utilities, man, it's just like, God. But airlines are like that. And so Southwest Airlines for the longest time was the best performing stock. And you look at what the difference was. What did they do differently? Well, one of the big things I think was the managing their balance sheet well. Not always is like, oh, we got to optimize the WACC. As an inside joke, Andrew and I tell ourselves, like Jerry on the board, right? And he's like, oh, there's Jerry. Oh, what is Jerry's idea? It's like, oh, let's optimize the WACC. I was like, how are we going to optimize the WACC? Well, we got to have the right amount of debt. I think, yes, on paper. So yeah, great question. Why not keep the business private? Access to capital. That's why. Do you think the U.S. has a healthy relationship with its allies currently? It depends on the allies. So the U.S., the way we described it, going back to April, well, no, April. So in Capital Mindset, I don't know if you're in Capital Mindset. If you go to the macro and tariffs room, go scroll all the way back, like all the way back to like early 2025. We discussed this quite a bit in there. I'll just actually spill the beans here because it's old information too. But the US split the world up into different buckets in this metaphor: the yellow bucket, the green bucket, the red bucket. The red bucket, adversarial nations that US wants to, put in their place. The yellow bucket is countries where the US does not know exactly where they align. So questionable allegiance. And the green bucket is nations that are favorable or aligned with the United States. So the United States, and there's plenty of actually public documents that you can go into and find of the U.S. actually making this case and discussing these very things. Not exactly the same wording, but with more or less the same idea. And looking at how in this case, the great adversary, the CCP and Russia have infiltrated some of these nations in some capacity or another, and the U.S. doesn't really know where or not they'll align. And the paranoia, you might say, oh, that's unfounded paranoia. I think at this point, we also have a lot of evidence to suggest that wasn't really unfounded paranoia. Given where some of the political parties in some of these nations actually lean much more towards one adversary versus at least the United States. And the United States is looking out for itself in this instance. And a lot of the nations that were previously yellow buckets, or obviously yellow buckets, have either flipped to green buckets. I don't really recall much of them flipping to red bucket. Some of them are still staying in the yellow bucket. And again, yellow bucket is unknown allegiance or unknown alignment. So with the nations that I think the U.S. cares about the most by far and needs, where the relationship has to be very much like, not voluntary is the wrong word, but cooperative. Most of them fell into the green bucket, thankfully. So like, Mexico fell into green bucket pretty quickly, despite what normies might read on the papers. Sometimes when you look at in practice, all the legislation that the Mexican Congress has been passing, and despite the words sometimes you hear out of them, because again, politics, actions wise, incredibly green bucket, like overtly green. Canada, I have my suspicions that they're going to end up in green bucket, and there's a lot of noise and stuff around there. And I'm optimistic for the Canadians, right? As soon as USMCA 2.0 gets signed and reaffirmed, then I would be bullish actually starting the business investment cycle in Canada, because you're going to have a return or sense of a confidence back. Because that's not a coincidence that if you look at back in 2025, business lending growth collapsed off a cliff. We have some folks in Capital Mindset who, let's just say, work in the governmental space that follows this data very closely, and that was a point of discussion we had back in the day. Now, where that data, and again, it's public. It's not like he told us private information, but it's public. It's just highlighted in part of a conversation, and then you obviously think, okay, what are the second order effects of this? Well, if business investment collapses, then you start to see other deterioration, other parts of economic measures, which is like kind of what we're seeing. Well, not kind of, we are seeing now, but optimistically, like the glass half full is when USMCA 2.0 gets signed, because I don't think they're gonna, fuck up that. That business investment will start to normalize, and then Canada's economy will pick up. So I'm pretty confident Canada will land in green bucket. So long story short, I don't want to spend too much time, because I'm looking at time and I could ramble for a while on this. With the countries the U.S. absolutely needs, yes. With the countries the U.S. doesn't necessarily need, but would love to have, I'm leaning also yes, but they're sort of like saying, oh yeah, we have to remember to say that we are aligned. We choose you. We definitely don't choose the other guys. But in between that, there's a lot of noise and people are very emotional. about this for some, well, not for some reason. I know why, but okay. Bro, boba. Oh, I've told you. I've answered your question like 5,000 times. I love you though. But yes, Microsoft's good. Microsoft's good. I just saw your comment. I was like, what the hell? I guess Dow is making new highs. Will drop now for correction at certain levels. Could buy. It's back down. If it does, I may enter. What's an example comes to mind of a management team that has snatched defeat from the jaws of victory, aka oh, I got one for you. Rick's Hospitality, RCI. Oh my God. So on paper, right? This business is like easy, simple, high cash flow generative. Bro, that when you said that, I'm like, oh my God, I'm thinking of these guys. Yeah. Easy answer. This one right here. A lot of stuff there, but you know, the old 3 buckets. What do I think about Adobe? Oh, he gave you another one. So look at this one. Adobe. So my problem with Adobe, and this is, I've said this before. I don't know if you're new. I haven't actually seen you around, so I think you might be new. But my thought process on all software, I don't think the market is telling you Adobe's dead. If Adobe was dead, apologize, I'm having like hiccups suddenly. You'd see it trade at like low single digit multiple. That's when a market is saying the stock is dead. The market is simply telling me when I see this is like, and I'm in the same bucket. I'm like, I actually don't know. Adobe's not going to grow at the rate it used to, i.e., it's not going to grow at 20% anymore. And so, what is a company that grows at 10% profit deserve to trade at? And what if the market is just uncertain about that growth even sustaining? Probably should trade at 10 times earnings. And I think Adobe's at 13.8 times earnings. So it's not even at 10 times GAAP earnings. On a forward basis, it's definitely not, because it's only growing GAAP earnings at like 12% or something like that. I don't have it in front of me, but point is, I don't think Adobe's dead. I think there's going to be a lot of friction before they lose anything really meaningful in enterprise and professional. It's the growth that's under question, and that's with a lot of software. So software went from, you got to understand this, software went from crackhead multiples. Let's define that. Multiples far exceeding the growth they're getting. That's why we went all creative with like the rule of 40. All these creative ways. Every time, the finance industry gets really creative with valuations, like, and it could last for a really long time, as we saw. Like we saw that with software, all the software. And to an extent, there's truth to having a high multiple and still being fine. Like if you are going to grow consistently 20% for a very long time, you could make a lot of valuations match up with that scenario. So you could trade at like 30, 40, 50 times earnings. And in this example, if you told me you came from the future and we're looking at the stock, it's trading at 50 times earnings, and you told me you came from the future and you're like, Fabio, hey, this company is literally going to grow their earnings at like 20 to 25% every year for, the next 15 years. Whatever company we're talking about, whatever it is, if it's trading 50 times and that's the outcome, it's undervalued. Does the market reflect that at that moment in time? Because does it suspect that that's like what you'll see in the current valuation? But like if you bought that, you would make money. If you held it for a long enough period of time, you will make money. You will make actually a pretty decent amount of money. But the market is trying to price in what it thinks it knows. And so with Adobe, the real alpha that you'll get on Adobe is like, if growth is going to reaccelerate. Oh my gosh. If growth is going to reaccelerate on Adobe, that's why you buy Adobe. You don't buy Adobe because the PE is low and you think the PE will be higher. Why will the PE be higher? Like what is the reason for the market to give it a high PE? Give me that reason. Usually the market will give it a higher PE if it is more certain of those cash flows. And so that could be part of your thesis. Although I tend to not like that thesis too much. Like the PE will just be higher. Okay. But like, for example, if you know in your thesis, like if you're confident, not if you know, because we don't know, none of us know, but if you're very confident that Adobe is going to reaccelerate earnings, yeah, buy it, because that's 13 times the market is not assuming Adobe reaccelerates. If you're taking the opinion like, oh, Adobe's gonna, they're gonna grow 10% profit per year, the market is more so just like concerned that it might not even be 10% in the farther future. Like it doesn't know what 3 years down the line it's going to be. What if in 3 years down the line it decelerates to 8%, then to 5%? So that's kind of like what the market's saying. It's not saying the growth is going to be negative, because that's what I see some people on X say. It's like, oh, Adobe must be dying. It's like the market's not saying Adobe's dying. The market would not trade Adobe at 13 times earnings if Adobe was dying. When a stock is dying, it's going to trade at a dying multiple. So I've been saying that for a while on software. And so you got to differentiate the companies you're confident are going to have that like reacceleration, or the growth is still high. So let's define high. If it's trading at a peg of under 1, for example, and then the market right now is doubting it, but then you're making a bet that it sustains, and then the market's going to realize in the future that it sustains, then you'll see that re-rate. And that's what's happening right now with Snowflake. That's what happened with Datadog. That's what could happen with ServiceNow at some point. That's not what's happening with Salesforce. So the market is parsing those out, and you're going to see the separation real quick, winners from losers in that. And you might have some of them that will become winners a little bit later, but they just have to prove to the market. The market's not, I think, being entirely retarded and irrational. The market's just saying, like, show me that your growth is sustained, right, at the high rate that we require of you at that multiple, or show me that you're accelerating growth. You show me those things, you clearly are getting rewarded. If you're showing, same as before, slight slowdown, not much clarity there, the market, the whole reason why you're in the penalty box is the market's like, I don't. And I'm saying market, investors, like buyers and sellers. What are the buyers looking for? Like, what would I be looking for in Adobe, right? What would make me jump in? I need to see that they're showing progress and they're reaccelerating growth. And I'll miss out on the first 10, 15%, 30%. It'll still be probably a cheaper price than what a lot of the Adobe bulls bought it at, right? So anyways, long rant, but I wanted to share that. Good question on UNH from X. Well, on this comment, no, believe it or not, so many of them were in Yellow Bucket to begin with. But yeah, it's not that the buckets were already predefined, and you look at like some of the behavior towards the US, and again, they're not adversaries, but to call them like best of friends was also like a really strong word. There was a lot more in the Yellow Bucket already. Okay, I love Dash. I'm psychologically long Dash, but I don't have a position right now. I'm looking at it all the time. I think Dash is super. The management team at Dash is phenomenal. On Uber, because I did get a question about Uber, I'll talk a little bit more about Uber and Dash. Are you expecting the Fed to raise or cut rates? Cut rates. I mean, that's a layup. Cut rates, or attempt to cut rates, or talk about cutting rates. But yeah, I expect them to try to cut rates. So I think they've already outlined what they want to do. They want to do QT, but lower rates. On the stocks, see. On StockTwits, all I see is red. Oh no. I'm sure if you talk about Evo, $2 billion. No, yeah. So finally, I think they're doing the right thing. This is what I've wanted from them from the get-go. And if they just figure out the problems with growth in Asia, et cetera, I mean, this business could easily, grind higher and higher and higher. But the buybacks, 2 billion, like finally, the dividends made no sense. If you really think your stock is cheap, just buy back the stock. Top 3 stocks that have potential for 10x relatively quickly. Ligma is my top stock. If Adobe goes up, you don't think it's dead yet. If it goes down, then it's dead. Great. Yeah. If Adobe goes down, yeah. No, in reality, like I said, clarify. I guess that was the answer to like the guy's question, but look at the profits. Market's definitely not saying it's dead. If the profit starts to crater, I tell you, the market will reprice that. Stocks is green for chip stock sell off. Bonds are up. Last time bonds was up, the market sold off for days. I mean, dude, it can cool off. I mean, the market's been running hot, man. It's fine if it cools off. How you could give us your gist on UNH, please? Structurally, company that's probably going to keep compounding. I mean, a lot of the recovery has happened. If you hold it at a good valuation, you could probably hold it for a very long time. They'll navigate all the regulations. It's fine. I got to get through all this because I got to answer the old questions and then wrap up. Look, Tio was talking about the private sector again. The bonds was Bloomberg talking about private bonds was with Bloomberg talking about private sector. Look, bonds are reflective of like forward growth. What the bond market is thinking about forward growth. Growth and inflation are connected, but what we're more seeing here is, in my view, the bond market rates going up is the bond market saying like forward growth expectations are higher. People think that when long-term rates come down, that's a good thing. That's not a good thing. All bond guys know it's not a good thing. So some of the bond doomers or economic doomers were always pointing as like bond long rates going down is a bad thing. The only way you think, if the inflation is a bad thing is because the inflation is coming from a stagflationary point. We're clearly not having that. That's not happening, the stagflation scenario. And if oil went too high, you would see rates come down, and that's not good. That's not a good thing, because that would be the bond market saying forward growth expectations are coming down because they're pricing in demand destruction. And then you would also see that start to happen in like the oil markets. The oil markets will start to reflect demand destruction as well. But yeah, if you saw oil rise way too high, you would actually see rates come down because people link it to inflation. That's not the inflation that bonds are pricing in. It's not supply shock inflation. That's more about supply-driven inflation rather than raw demand and money creation driven inflation via lending growth. So that's really what bonds are more pricing in. So people don't know that difference. And if you look at other sources like Truflation, the real-time one, they're still showing that inflation's underneath, looking through the oil. It's rather cool. I think it rose, but it's not very high. It's still rather tame. And so it still kind of screams to me, bonds, again, looking at everything else, are pricing in higher growth. So if you want to see the difference and you want to think that's a good thing, oh my God, no, that's not going to be a good thing. If oil goes up a ton and suddenly you see the long end come down, yeah, market's telling you bad thing coming. Because yeah, and you also see that again in the oil futures curve. Damn, you're when blew out, taking down private credit, just do it already. Sheesh. Yeah, I know it's happening eventually, bro. I hope the VIX pops. I made so much money on VIX. Trump was talking today. I was giving around tomorrow, 8 p.m. tomorrow. Look, I'm Marvel report close. Could go up, down, or yeah, I like that prediction. Could go up, down, or sideways. UPS was looking so good that FDX. I don't like. I prefer JB Hunt. JB Hunt. What is your favorite high risk, high reward stock? Oh, high risk, high reward stock. Turning Point Brands. I like Turning Point Brands. I'll give them a shout out. Yeah, Meta subscription is interesting. Oh, dude, I know all the white girls are going for it. Oh, baby. UPS PR. I haven't looked at pre. And Micron hit new highs this week. That was up 150 in a day. Yes, it has. Oh, I think are you behind? I think you might be behind because you're commenting on things from before. Do you know what's going on with Abbott Labs? I just checked. It was down a lot. No, all med tech is weak. If you actually look at my partner Andrew, he tweeted out the hedge fund exposure. I'll bring it up. Let me show you. And we're really happy because our largest sector is under-owned, which means one day it could be owned a lot more. Yes, super exciting stuff. I'm sorry if I'm frozen. Does this? I don't know why on my browser. Because I know I have to come back. Okay, I'm back. Don't worry. I know I was frozen for a second. All right, let me show. I'm sorry about the blurriness, but here you go. So, real quick, just like communicating something here to you. This is showing you like the percentile exposure. What you should notice is financials are heavily underexposed. Information technology is heavily overexposed. So at some point, this will correct, and so money will flow and rotate. And so one of our largest. Actually, our largest exposure is in that financials, and actually, that's how you know we've done really well. We've actually produced alpha because, like, even despite being heavily exposed to financials, we've actually picked good enough ones that we've done really well. Yeah, like information technology is the crowded spot. Healthcare in there is also under invested, and so yeah, healthcare, relatively speaking. So yeah. I was looking at Hunt and all of them today. Yep. BSX fell hard today. Lower outlook. Yep. High risk, high reward is Klarna. Klarna, I like too. Klarna, I don't think it's as okay. I don't think Klarna is as high risk. That's why I didn't think of them. I actually think Klarna is okay risk and decent reward. Let me see the current price, but because you got to understand the price. Yeah, 17. It's still 6 billion for this, which is kind of crazy. So I don't think it's that risky of a price. When we talked about it a month ago, it was like $12. That was stupid, but I don't think it's as high. That's why I didn't think of them. But Turning Point has like some things that could go wrong, but the reward on the other side is like probably a 10x. So, anyways, I was asked a question. I'm finally getting back to it. Right? What is this? What does all this do? Big. Let me make it big like that. Okay, cool. And it's tall and wide. What's better? I will do tall and medium. All right, so let me put this away. All right, so what do you look for in such a memory stock? To cyclical wonder party with stock for me. Oh, we already answered this one. I'm long American. Oh, I already answered this. Why did I start this? I already answered this. Dave, yes. So Dave got entered into the S&P 600 ETF or index, and it's going to be included in all these ETFs. So yeah, it's nice. It got a little bump after hours. We'll see what happens. Okay, so these questions on Uber and Intuit. So we'll start with Uber, and I'll talk a little bit about Dash. So Uber, I don't hate the business. Delivery is my favorite part. That's kind of why I like Dash a little bit more. Dash is more focused, but no, Uber is shown some promise, because what we're seeing in like markets where we have San Francisco, what I like about what I'm observing in San Francisco is actually regaining some market share from Waymo. That's very promising. There's still, the looming threat of AVs, et cetera. The bulls will say they're going to be, the distribution for this. The bears will say way too early to tell, or flat out say, oh no, AVs are going to take over. I'm kind of in the middle. I really don't know. I see both arguments, no position of skin in the game. But I do see like delivery is much more defensible. I like that. That's kind of why I lean on Dash a little bit more over Uber. Everyone I know just uses Dash. I use Uber Eats. I'm the only one I know who uses Uber Eats. But that's not a reason to trust that and say like, oh, therefore, Dash is better. What I see is like in market share, clearly more people use Dash, and I think delivery is just much more monetizable from an ads perspective. And there's competition coming in from the likes of Amazon trying to go even to like 30-minute delivery, but I think they serve two different things completely. Okay with both of them surviving and thriving, or all three of them surviving and thriving. Yeah, but if ride hailing stays around and they actually end up becoming, this sort of like way for all these AVs to, service their customers and make sure demand's filled up, then yeah, they're going to be probably one of the more not profitable, but attractive parts of the ecosystem to be involved with. And the AVs are going to turn out to be like some sort of shitty commodity. So yeah, that's where I stand with it on Uber. Let me refresh myself on the price, because to me they're still in like the mid to high 70s. Oh wow, okay, so it's at low 70. It's at literally at 70. Man, I'll take a look again at it, to be honest, but yeah, no position. And in theory, like they should be really efficient business at this point, making tons of money. Growth, from what I gathered and remember, it's like 20+% for the foreseeable future. So I think really the question that I would have, and some of the other capital mindset members have brought up, because this has been debated before, for Uber bulls versus some of the Uber skeptics. That's what I love about the community. We have like just all these different perspectives. We go hop on Voice, they talk, we all talk, we hopefully get more ideas out of it. And people who can defend their ideas, they stay more bullish. People who maybe have been bearish, maybe become bullish, or maybe they stay bearish, or skeptics is better phrase. But the skeptics have argued, it's like, we just don't know what's going to look like in the next 5 or so years. So we'll have to wait and see. And the question's like, what's the terminal value of it? And I tend to agree. I don't have a hill that I will die on right now. I'm not going to die on the hill saying they will 100% be the thing that just allocates all the demand. I think Dash will for delivery. I think they'll do it. So just joined the stream. So I'm not sure if it's been discussed, but any thoughts on Intuit 18 times gap? Same exact concerns as all other software. So 18 times gap. It's not. Thank you for using gap, by the way, and not the often cited on, for some reason online, the adjusted figures, because everyone's looking at the 12 PE or whatever. But yeah, I think the TurboTax business is the whatever part of the business, the cash cow. I think AI will do fine with QuickBooks. I think small businesses like plug and play, they're not going to leave QuickBooks. They're just going to use whatever tool, and there's options or to monetize that further. So yeah, I don't hate it. Maybe it gets better, maybe in the future, in terms of price. Maybe you can pick it up at like closer to 10 times earnings, and then I think it's being de-risked a ton at that point. But no, I don't really have negative things to say about it. Okay, actually, no. One thing, MailChimp. What the actual fuck was that? But outside of that, decent. Like Credit Karma is a good franchise. TurboTax, probably still cash cows. They're transforming it a little bit there. We'll see what that looks in the future. But yeah, definitely on my watch list. I'm interested, but no position. I've been looking at Lyft since PE has dropped a lot since last year. Yeah, I mean, Lyft is like the same question as Uber in that sense, and you're just kind of saying there will be two. There not will not just be one, but Lyft, honestly, you know what, man? If I had to guess, someone buys Lyft, I could see that happening. I could see like Amazon buying Lyft and then just using Lyft platform to expand, Zoox, Google buy, I don't know. Someone could buy Lyft. And that's the problem with, even betting against Lyft. I would not short Lyft. I'd be terrified to short Lyft for that exact reason. Like any of these guys could come in and just go whoop, scoop it up, and have this like network immediately, and then argue, hey, it's to be more competitive against Uber, so it's actually good for the consumer. Yada yada yada. Who knows? That's my fear of like even thinking about shorting something like Lyft. So I don't even know what price they're at now. Oh yeah, $13. So they have come down. So the short would have worked, but like I would have been scared to short here. I'm scared to short here. I'm very scared to short here. So I do not think it's a short. I don't think Andrew thinks it's short. I think Andrew expressed this very same concern. And it's not a very expensive stock, but yeah, could easily be bought up by someone. This is nothing. 5 billion, not worth it. All right. Thoughts on Toast? I like the company. Think they'll do fine. Dash. The only scary thing is DoorDash is coming out with their own product. And when I said before that I'm psychologically long Dash, this management team, they are amazing. They are really, really, really good. Like if you're buying Dash, you're betting on the jockey, and they really know product development. So that's the one thing about Toast that it's like, but I'm sure Toast is so entrenched. That's the thing. So like I think there's space for both of them. In fact, maybe Dash will be much more of a threat to a Fiserv with Clover. Like they're probably fucked. And there's still a lot of consolidation, believe it or not, in the industry. But yeah, Dash coming out with their own POS system. That's what's really hurt Toast recently. So a lot of the analysts became more neutral to bearish just on that. But it's Toast. It's not, I said all those things about Dash. I don't think poorly of the Toast management team. I think they've done a really good job at narrowing a niche. And there's a lot of room to better monetize that in the future. So, I'm generally optimistic there. Okay. I think, it's been 2 hours. So thank you guys so much for joining me today. As always, the link's in the description below. If you want to help out the channel, we have the sponsor, Physical.ai. If you use that, help support me. If you're curious of joining Capital Mindset Club and having access to me literally on a daily basis, you can go down and check that out. And, nothing said on this podcast or live stream, whatever you want to call this, is financial advice. And all the opinions expressed today do not express the opinions of Fractions Capital. These are my own opinions and just my own. And with that being said, I enjoyed this a lot, as always. Thank you guys so much for joining me today. And I'll see you guys on the next one. Bye.